In the United States, stable wealth is rarely the result of sudden wins or dramatic financial moves. It is usually built through consistent thinking patterns applied over many years. These individuals do not rely on shortcuts. They rely on structure, discipline, and repeatable systems. Their financial decisions often look boring from the outside, but over time they create resilience, flexibility, and control. One of the biggest differences is how stable wealth households define money itself. For them, money is not a tool for status or emotional relief. It is a resource used to increase stability, reduce stress, and create optionality. Every dollar has a role. Some dollars protect. Some dollars grow slowly. Some dollars improve daily life. But no dollar is treated casually. This mindset starts with income management. Americans with stable wealth do not think only in terms of how much they earn. They think in terms of how income behaves. They value predictability and durability. A steady income stream that continues during economic stress is considered more valuable than a higher income that depends on fragile conditions. That is why many stable wealth earners focus on skills, professions, or businesses that are difficult to replace and not dependent on trends. They also separate income from lifestyle early. As income rises, lifestyle does not rise at the same speed. This gap is intentional. It creates surplus. That surplus is what fuels stability. Instead of asking how much they can afford to spend, they ask how much they need to preserve flexibility. This is why many stable wealth families live in homes that cost less than what banks would approve them for. They treat debt capacity as a risk factor, not as a spending target. Another key difference is how they think about expenses. Expenses are categorized by impact, not by desire. Fixed costs are kept low and predictable. Housing, transportation, insurance, and recurring bills are optimized to avoid future pressure. These households understand that once a fixed cost is added, it becomes a permanent claim on future income. They are cautious about adding long-term obligations, even during strong economic periods. Discretionary spending is approached differently as well. Stable wealth individuals do spend on comfort, quality, and experiences, but they do it intentionally. They avoid spending patterns that create ongoing dependence. For example, they may spend more on a durable item that lasts many years, rather than cheaper options that require frequent replacement. They evaluate spending based on total lifetime cost, not just the purchase price. Emergency planning is another major difference. Stable wealth households treat emergencies as inevitable. They do not ask if something unexpected will happen. They ask when. Because of this, they build cash buffers that are separated from daily accounts. This money is not invested aggressively. Its purpose is protection, not growth. Having this buffer allows them to avoid panic decisions, high-cost borrowing, or forced asset sales during stress. When it comes to debt, their thinking is cautious and selective. Not all debt is treated the same, but all debt is analyzed carefully. They focus on how debt behaves under pressure. They ask what happens if income drops, if rates change, or if conditions tighten. Debt that creates fragility is avoided, even if it appears affordable in the short term. This is why many stable wealth Americans prioritize paying down high-stress obligations early. They also think differently about time. Time is treated as a financial asset. Decisions are evaluated based on how much future time they protect or consume. A choice that saves money but adds ongoing stress or complexity is often rejected. Likewise, a choice that costs more upfront but simplifies future decisions is often accepted. This long view shapes how they choose careers, housing, and even geographic location. Another important distinction is how they respond to financial information. Stable wealth individuals do not chase headlines. They understand that most financial news is designed to create urgency, fear, or excitement. Instead of reacting, they focus on fundamentals. They track cash flow, savings rates, and long-term allocation. They are less concerned with short-term movements and more focused on whether their system still works. They also separate identity from financial outcomes. Money is not used as proof of intelligence or success. Losses or setbacks are treated as data, not personal failure. This emotional separation allows them to adjust without overreacting. It also prevents ego-driven decisions that often lead to unnecessary risk. Stable wealth Americans also invest in knowledge differently. They do not try to learn everything. They focus on understanding core principles deeply. Budgeting, taxation basics, risk management, and long-term allocation are prioritized. Complex strategies are approached cautiously and only after fundamentals are solid. They understand that complexity increases error risk. Another major difference is how they view ownership. Ownership is not about accumulation for its own sake. It is about control and reliability. They value assets that produce consistent utility or cash flow over assets that depend on timing. This applies to homes, businesses, and financial holdings. The question is always how an asset behaves across different conditions. They also design their finances to reduce dependence on any single factor. Income sources are diversified over time. Expenses are structured so that loss of one income stream does not collapse the entire system. This redundancy is intentional. It is not about maximizing returns. It is about surviving disruptions without permanent damage. Social comparison plays a very small role. Stable wealth households are aware that many visible lifestyles are financed through leverage and future obligations. They do not measure success by appearance. They measure it by control, calm, and consistency. This protects them from spending traps that reset progress. Tax awareness is another area where thinking differs. These individuals understand the tax system well enough to make informed decisions. They plan income, savings, and investment timing with taxes in mind. They do not evade or manipulate. They simply structure legally and efficiently. Over decades, this awareness compounds into significant retained value. Finally, stable wealth thinking emphasizes process over outcomes. A good decision is defined by whether it followed sound logic and discipline, not by short-term results. This mindset allows them to repeat good behavior even during periods when outcomes are temporarily disappointing. All of these patterns share a common theme. Stable wealth is built by removing fragility before chasing growth. It is about making fewer mistakes, not more dramatic wins. In the next part, we will break down how these thinking patterns translate into practical financial structures that ordinary Americans can implement step by step without relying on speculation or high-risk behavior. The thinking patterns of stable wealth Americans eventually show up in how their financial systems are structured. These systems are not complex, but they are intentional. Every account, every allocation, and every decision has a clear purpose. This clarity reduces errors and increases consistency over time. One of the first structures they build is separation. Money is divided by function, not convenience. Daily spending accounts are kept separate from savings, reserves, and long-term allocations. This prevents accidental overspending and reduces emotional interference. When money has a clear job, it is less likely to be misused. Savings is treated as a fixed obligation, not as leftover money. Stable wealth households decide their savings rate first, then design spending around what remains. This reverses the common approach. Savings happens automatically and consistently. Over time, this habit matters more than the exact percentage. They also prioritize liquidity before growth. Before focusing on expansion, they ensure that short-term obligations are covered. This includes emergency reserves, predictable expenses, and near-term needs. Growth assets are added only when the foundation is stable. This sequence prevents forced decisions during downturns. Another structural element is simplicity. They avoid unnecessary accounts, overlapping tools, or complicated setups. Complexity increases the chance of neglect and mistakes. A simple system that is maintained consistently often outperforms a complex system that is poorly managed. Risk is managed through balance, not avoidance. Stable wealth. Americans understand that avoiding all risk limits progress, but unmanaged risk destroys stability. They spread exposure across different types of assets and time horizons. No single decision is allowed to threaten the entire structure. They also review regularly, but not obsessively. Financial check-ins happen on a schedule. Adjustments are based on data, not emotions. This prevents reactionary changes driven by short-term noise. Discipline in review is as important as discipline in saving. Lifestyle choices are aligned with financial systems. Housing, transportation, and daily routines are chosen to support long-term stability. This alignment reduces friction. When lifestyle and finances support each other, discipline becomes easier. Perhaps the most important takeaway is that stable wealth is not about intelligence or access. It is about behavior repeated over time. Small advantages applied consistently create large differences over decades. This approach is available to ordinary Americans. It does not require speculation, leverage-driven strategies, or constant monitoring. It requires patience, clarity, and respect for risk. By focusing on structure before scale and stability before expansion, financial progress becomes more predictable and durable. This is how stable wealth is quietly built in America.